I went back to Mexico City and I launched this accelerator at the time that the dot-com crash happened. I remember I raised about $1 million and everyone else shut down. So I had a monopoly of the word entrepreneurship in Mexico City because everybody else left.
And what's the mindset of a successful founder?
I don't care about metrics. I don't care about scaling your company. I care about the obsession that you have about solving one particular problem that hurt you. And you're not going to rest until you fix that damn problem.
What's the problem you're obsessed with that you're solving for Kauffman Fellows, for venture capital with Kauffman as a platform?
I think the thing we are obsessed about is venture capital is damn hard. So we make those exact comparisons on what is the graduation rate of 0 to C to Series B to IPO, or 0 to Fund 1 to Fund 4 to Fund 9, I think is where we made a cutoff. And the percentage graduation rates are exactly the same.
Fernando, thank you for joining us on this episode of Catapult Code. We're very excited to have you.
Yeah, excited to learn about the journey, the founding journey that a company goes through, which we'll document through a series of conversations, but also a founding journey a venture capitalist goes through, which will be an interesting comparison to.
I'm very happy to be here. Thank you for having me.
When we think about your orbital shifts and kind of these different levels, you have these wonderful chapters. One was very focused on entrepreneurs and building that ecosystem. It started in 2002 when you and Richard Smith were writing a paper for the entrepreneurial culture and environment in Mexico for both the Fox and Bush Partnership for Prosperity. And that felt like the first orbit that brought you into the Endeavor landscape. I'm curious, what would you tell yourself back in 2002 that you know today when you wrote that paper?
Yeah, so the story is I was living in LA in 1998, between 98 to 2000. I was studying there. That's where I met this professor of mine, Richard Smith, at the Claremont Graduate School of Economics. And I remember it perfectly. I was doing a PhD in economics. All this stuff that I wouldn't understand today, but econometrics and macro and micro and all that stuff. But I was forced to take one course out of the business school to complete the program. And the business school, there is the Peter Drucker School of Management. So I look at the catalog of courses and there's this venture finance. And I had no idea what venture meant at the time, like clueless on the concept of entrepreneurship whatsoever. So the first case study of that class was a case study of Amazon.com. This is 98 and a half. The company was 3 years old at the time, and it had a run rate of $100 million, and it was selling books. There was nothing else but books. And at that time, I said, hey, I'm in economics. I love the concept of economic development and how do you create wealth. And I've never heard of this concept before, but this guy created $100 million of revenue in 3 years. This is where I want to stick myself to. I want to stay into this thing called entrepreneurship. And it was, the height of the dot-com boom. I'm from Mexico. I went back to Mexico City, and I launched this accelerator at the time that the dot-com crash happened. And I got very lucky because that meant, as I was just starting, I remember I raised about $1 million, and everyone else shut down. So I had a monopoly of the word entrepreneurship in Mexico City because everybody else left. And that gave me certain influence. And it's at the time that George Bush got elected in the US, the son. And then President Fox threw out the dominating party also in the year 2000. So it's very exciting times. And the two of them are ranchers, and they got along pretty well. And they said what Mexico needs is entrepreneurship. That's the best export that America can give Mexico. So we need to find someone in Mexico and someone in the US to work on a partnership for prosperity around entrepreneurship. And there was no one else in Mexico but me. So I called in Smith and said, let's do this. Then 9/11 happened, and the priority of the US shifted entirely to something completely different. So that paper saw the light of day for maybe about 2 weeks, and then it was gone. What we got wrong was a prediction that that Mexico would attract a lot more venture capital just because it was sort of this natural phenomenon of foreign direct investment that eventually lands into venture capital. And that was completely wrong. I think what we got right, we were very clear to understand that, because at that time, SaaS was becoming the thing in the US, cloud. We knew that Mexico had no competitive edge creating software for businesses and renting seats. So there's no point in doing that. So we knew that Mexico would have heavy machinery, heavy industries. So we knew that entrepreneurship had to involve some physical assets or the transformation of physical assets. And I think that ended up becoming fintech. When you think of fintech in Mexico, it's less about just the digitalization of money, but it's the transactionality of physical assets. And clearly, fintech in Mexico City is the thing that has been popping up crazy and attracting a lot of VC. But we got wrong the idea that VC would become a lot more established in Mexico. It didn't happen. I don't know if it's ever going to happen. But
And I'm always fascinated when someone has a 25-year lens to which means many financial cycles, and especially in an emerging market context. And in all of these analysis, when you think of venture financing, there's a time window. It's 8 years, 10 years. So there's a shorter time window to do what other companies may have taken many long windows. So does the notion of addressable market size, TAM, ever come in when you think of it in the emerging market lens? And I speak this as a founder building from an emerging market and now moving into a larger market where the TAM suddenly seems to multiply. Did you have that arc in your analysis?
So I guess the first point that you make, the cycles, I believe venture capital is mostly acyclical, in that whether it's up in the cycle or low in the cycle, nothing says that if you invest in the right entrepreneurs, whichever point of the cycle, by the time of exit, you're going to be in an entirely different cycle. Mm-hmm. And if you made the right bet, again, at exit, it doesn't matter if it's up cycle or down cycle, you're still going to have fantastic exit. So it should be acyclical. The number of times that the market has predicted that the venture capital model is broken, the math doesn't work, there's too much money in venture, all of those things, that happened in the dot-com crash. That happened in the global financial crisis, at the beginning of COVID. It happened in 2022. So the cycle has been there, and venture capital has gone nowhere but up. Mm-hmm. And the same thing goes for entrepreneurship. So I don't really focus or care about cycles. And in fact, at Kauffman Fellows, we don't talk about the current narrative, the current ship. We don't care about that. The money of venture capital is actually even more acyclical because you're a limited partner institutional. Your time horizon is 50 years. Mm-hmm. It's not 5, it's not 10 years. Their LPs don't care about cycles whatsoever. So no, I don't believe in cycles. I do believe in at least economic cycles or political cycles. There are product cycles, of course. Like if you go back to the dot-com crash, cloud came in, broadband came in, which made SaaS possible. And then 2008 global financial crisis, the iPhone and the Bitcoin paper were produced in 2008, right? And then you think of COVID and its remote work that gave rise. And 2 years ago, it's ChatGPT. So there are product cycles that you want to be. They just happen to coincide with rough market cycles, but I don't think there's anything necessarily tying the launch of ChatGPT with the crisis of venture capital 2 years ago. It's not connected, or the iPhone to the global financial crisis. Those are the cycles that you care about, product shifts. Whether you're a founder or a VC, you want to get on that wave. Mm-hmm. Of the next big technological component changing the world.
And so when you're building with such long-term horizon, what's the mindset of a successful founder, or what's the trait that you would pick, just given that acyclicality? What is the one thing that should stand out? And you probably work with hundreds of investors and managers.
And thousands of entrepreneurs through 15 years at Endeavor. I think I would love to say there's this one trait that you. I I think it's obsession, but the obsession shifts. So when you think of starting up, the actual startup of your own company, if I'm a pre-seed venture capital investor, what I want to look in you is, I don't care about metrics. I don't care about scaling your company. I care about the obsession that you have about solving one particular problem that hurt you. And you're not going to rest until you fix that damn problem, right? Like that's what I want to look at. If I'm a Series A investor, what I'm looking for is you have a way to solve that problem, but now it's product market fit obsession, which means that I don't care about scale, I don't care about metrics, I care about those 10 customers, very small, that you are obsessed about them loving you, not liking, loving your product. And that's all I want to hear. That if you shut down, they will die. Like they can't let you shut down. That's the second obsession. And then if I'm a Series B, Series C, you got founder market fit, you got product market fit, then you can call it sort of talent or team market fit, because it's all about execution and scaling. That's where I care about your metrics, because your obsession then is scaling. And that's execution. And that means that you're obsessed about having the best team, attracting and retaining the best team. So the one trait is obsession. It's just that what the founder is obsessed about shifts depending on the cycle that you're in your startup.
Yeah, that's fascinating and fitting right into the orbit shifts that we want to talk about. I want to go back to your origin story a little bit more. There was a second paper where you talked about 4 cities emerging as the next bet, and this was 2016 or 2015, 2016, that time frame. I'm curious how you picked those places for as in your paper, and I'm also curious to know why you left Indian market out of that.
So the context is, I ran the Office of Endeavor in Mexico for, I think, 6 years, 2004 to 2010. I would say my focus, Endeavor was a very new organization. Endeavor is sort of the Y Combinator for the rest of the world. At the time, Endeavor was more focused on selecting entrepreneurs comparable to a seed stage, helping them reach a Series A. Now it has shifted a little bit, but I think my time from 2004 to 2010, my focus was product market fit. I'm not a founder. I was hired into the job. But there was no real product. So I just focused on creating a product that entrepreneurs in Mexico would love. That worked out really well. And that got me the role of president of Endeavor Global in 2010. At that time, Endeavor was mostly a Latin American organization, Brazil, Argentina, Chile, Uruguay, Mexico. I think we had launched Colombia by then. And then outside of LATAM, we had an office in Istanbul and an office in Johannesburg that I think we were just opening at the time. So when they brought me in 2010, the board told me the goal is to scale. Like we have product market fit. Now let's go to execution and scaling. And the goal was go from, I think we were in 9 countries at the time. We want to be in 30 countries in the next 5 years. So we started to make the list of places. And right out of the gate, I will tell you that both China and India were so difficult to comprehend for us. This is 2010 at the time, that they never, Russia is probably the third one that I would say we never even turned to look at those markets as saying that's really, really far from the headquarters in New York. That's when I moved to New York. Mostly LATAM, and then Istanbul and Johannesburg sort of over here. It just seemed completely out of scope. So we shifted our attention to which are the other cities that we believe are going to become the hottest tech ecosystems in the world, that are currently not Silicon Valley, are not New York, are not London, and are not Tel Aviv, because those were sort of the 4 that were already formed. And again, excluding China, India, and Russia. And that meant that we started to detect Berlin, we detected Madrid, we detected Dubai, Riyadh, Cairo. So certain places that when we tried to understand what was going on there, why where we've seen this little bubbling of entrepreneurial ecosystems, the early stages, they all had similar characteristics. And it was that they were epicenters of talent that wanted to live there, that wanted to stay there. So in a way, my entire point of view of building entrepreneurial ecosystems has come down to if I'm the mayor of a city or the president of a country or the king of whatever, and my mandate is to develop an entrepreneurial ecosystem in this city, there's one and only one thing that I can do, which is make that city incredibly attractive for talent to live and stay. And how do you make that? It has nothing to do with entrepreneurship. It has nothing to do with venture capital. It's good schools for my kids. That's kind of important. Imagine if I'm very talented and I become very rich because of my talent, because of an IPO, whatever. Would I stay here if it sucks? No, of course not. I want to give my kids the best. I want access to culture. I want access to entertainment. I want access to good food. I want access to security and safety. So for us, it was sort of, let's find those cities that currently have that, because that means that they are attracting and retaining talent. If that happens, the next thing that will happen, and that's something that, again, there's nothing you can do about. No city in the world can plan for that. But every one of these, let's call these cosmopolitan cities in the world, every single one of them is going to have its Flipkart moment, its Mercado Libre moment, its Nubank moment, its Souk moment in Dubai, its ICQ moment in Tel Aviv, its Fairchild Semiconductors in the Bay Area. There's nothing you can do to plan it. There's no way, right? But it will happen. The thing is that if it happens, Flipkart in Bangalore, they start. Imagine if 1 year they raise a Series A and the investors tell the guys, you have to move to Silicon Valley. And the entire company shifts all of it to Silicon Valley. The amount of talent that you lose out of that,
it's massive.
I would say India would have lost 50% of its current tech ecosystem today if that had happened 15 years ago. So you cannot predict the next Flipkart, but it's going to happen. 11 Labs out of Warsaw, it happened. I think I love the story of Shopify out of Toronto as well, right? So, and Shopify tells a story that they chose Bessemer Venture Partners as their VC because all the other Bay Area VCs were telling them you have to shut down in Toronto and move to the Bay Area.
Move to the Bay Area.
And Bessemer is the one that told them, no, stay where you are, right? So what do you have to do as a city for an ecosystem to thrive is make it incredibly attractive for successful people to want to live there. Back to your question, a ranking, which is not a ranking, but where do we want to launch the next Endeavor office? We were looking at those metrics of quality of life. Nothing, no foreign direct investment, currency devaluation, political. We couldn't care less about that stuff because, again, we don't care about cycles.
It's a very fundamental, yeah.
Last year when I first joined Kauffman, one of the most potent visualizations you put together was the multiplier effect. And I think it speaks to when you were looking at markets to build in, did it have enough infrastructure where people wanted to stay? But you talked about these amazing companies, the new banks of the world, but then you would show the impact that would have of all these spinoffs. I mean, people would call it the PayPal mafia, but that phenomenon happens throughout the world. It seemed very embedded in your strategy of how you expanded.
100%. That's once you see it, you cannot unsee it. Like it gets embedded in your brain, and then nothing else matters. So the logic goes like this: you launch this startup, and your currency is 100% of the equity, and then you start hiring people, but you don't have money to pay them, so you pay them with equity via stock options. If you start to become successful, there's a secondaries market, there's partial exits, and then a full exit, M&A, IPO. The amount of people that work for you that are going to make a ton of money. And these are people that have been with you for the last 10 years, taking a company from zero to $1 billion or whatever amount you want at the top, learning tools of the trade that you don't learn anywhere else, how to scale, very, very, very specific. So if you think of that, the amount of people that are going to be, let's say, in their mid-30s, relatively young, with a couple $1 million on their left pocket, and that knowledge at exit, launching the next thing and launching the next thing. So think of it as waves of cycles. The cycle after the exit of Mercado Libre in Argentina created X number of successful, brilliant, experienced millionaires. Couple million, let's not call them set for life, right? Each of them starts something with that knowledge. Mm-hmm. So the next generation is even better than the first one, right? And then they have their exits, and some of them. So the next wave, it's an order of magnitude and an order of magnitude. The thing in the Bay Area, the Silicon Valley, is that they've been doing that for 60 years. Mm-hmm. You can trace it back to Shockley Semiconductor, to Fairchild Semiconductor, to Apple, to Intel, to PayPal. Like, you can trace that line. I think India has been doing it for maybe now 30 years, 25 years.
20 years, yeah.
If we think, if this cycle repeat every 10 years and it's an order of magnitude bigger, that means that, yes, Silicon Valley is 3 orders of magnitude bigger than India, which is obvious, not normal. But if you think in 30 years, the Indian entrepreneurial ecosystem should be what the current Silicon Valley ecosystem should be. But Silicon Valley is going to be, again, 3 orders of magnitude ahead, right? So, and go back to Argentina and Buenos Aires, and they've been doing this for 15 years. Mm-hmm. So the Indian ecosystem is 2-3 orders of magnitude bigger. So I just feel that these things happen. It's almost inevitable for them to happen unless you screw up and your city becomes unlivable. And the successful people leave before these things take. And that has happened in many parts of the world.
When you think of, as you lead Kauffman, the 2 questions I have are, what's the problem you're obsessed with that you're solving for Kauffman Fellows, for venture capital with Kauffman as a platform? And do you think of the multiplier effect relating to how you're building out Kauffman itself with this global perspective that you have?
It's a great question. I think the thing we are obsessed about is venture capital is damn hard. I think we deserve, the venture capital industry deserves a little bit of hate or a little bit of mockery, because there's certainly been bad actors in the industry. And you just have to look back at 2021, where everybody and their grandmother launched a venture capital firm. And every user on Twitter became a venture capitalist in 2021. Like, money was free, so cost of opportunity is nothing. Just launch a VC firm. And you get this impression that venture is, I take $1 from this guy, I send it over there, and then I sit back and enjoy my yacht. Venture is an incredibly hard thing to do right. It requires a ton of skill and a lot of changing your original assumptions because the technology shifts. Just as hard as launching a startup that becomes successful. I think it's exactly the same. If anything, I would say I can launch a startup today with maybe $1 million. I cannot raise a fund. I cannot start a fund with $1 million. I need at least 10 million, let's say. So it's even probably harder to start a venture capital firm than a startup. So our obsession is venture capital is hard. How can we help the fellows that we select save a little bit of years in the learning process that it requires to become an incredible venture capital investor and build an incredible venture capital firm, which, by the way, those are 2 different things, the becoming a great investor versus building a great firm. So our 2 products, right? It's 1 product. We're a school. We're an education program, but we split the program in the courses that are focused on becoming a better investor and the courses that are on building better firms. We don't care about anything else but making sure that we have the state-of-the-art knowledge to be able to teach that to the fellows that we have in the room. Because venture is hard. It's not going to get easier. But I feel that if we do our job right, we shave a few years out of the pain of learning process for venture investors.
Fernando, can you talked of the notion of comparing the venture capitalist journey and the startup journey, and there's a recent report that we talked about 0 to 4. Can you talk about the parallels between the founder journey or a startup's scale up journey and the venture capitalist journey? What is it? What are the parallels there? And a little bit more about the report.
Yeah, I would love to. The origin of the report was that I feel that there's a lot of content out there, venture capital related, on selecting and investing in great entrepreneurs. And actually, a step back is, if you're going to start a company today, like, you have all the knowledge in the world already documented, like how to start any company, any industry, at any stage. There's all the documentation that you need to do that. For venture capital, I feel what's very well or getting better documented is how do you select entrepreneurs? How do you build a personal brand? How do you become a good investor or a better investor? There's certain key metrics that you can follow, both heuristics and data-driven, to make better selection of startups based on certain industries. What I don't think gets talked enough is, in the same way that you can split the success of a startup is the founder's obsession about a product, but also the founder's obsession about a team and the firm behind that product. It's exactly the same thing in venture, where VCs, I feel, are too obsessed about the investment part, which is a product, but not too much obsessed about building a firm, the talent behind the firm. And the origin, the document 0-4, the research was let's assume that to be successful in venture, you have to be a good investor. If you don't have good returns, nobody will give you money for your next fund, period. But let's so the document actually starts with that. Like, say, you have to be good, but this document is not about becoming a good investor. We know venture capital firms that have had good returns but implode or struggle to raise the next fund. So what are the reasons of why that happens? And it's called 0-4 because the heuristic in venture capital, the universe, is that you launch your first fund. So you're at 0, you have no idea. You launch your first fund, you're immediately labeled an emerging manager. You're learning. And then you launch your fund 2, and then your fund 3, you're still labeled an emerging manager, but then magically you close your 4th fund, and now the market calls you an established manager. And then by the time you get to fund 9, fund 10, the market now calls you a franchise firm. So the accolades in VCs, from emerging to established, from established to franchise. So at this report, we said, let's interview fellows, Kauffman Fellows that have launched a venture capital firm and are currently deploying out of a fund 4+. Because that means they're the ones that succeeded in this learning curve from emerging to established. And the document, the research documents those things, that how they build their firm, and I'm happy to talk about that. But I joke that as much as I wanted people to really share the learnings of this report, the only thing that is getting shared right now is first page, because we do this comparison of launching a startup to launching a venture capital firm, and we say, so you're at 0, entrepreneur with an idea, and at 0, a VC with an idea to launch a fund. And reaching a Series C is comparable to closing a fund 1. And then I think reaching a Series B is comparable to reaching a fund 4, from emerging to established. So it's sort of this founder market fit, product market fit timeline. After Series B and after fund 4, the focus of these entrepreneur VCs is IPO, like becoming this franchise firm or IPO, right? So we make those exact comparisons on what is the graduation rate of 0 to C to Series B to IPO, or 0 to fund 1 to fund 4 to fund 9, I think, is where we made a cutoff. And the percentage graduation rates are exactly the same, which to us was baffling. But we thought, oh, that's a cute chart to put on page 1. And then how do VCs actually go from this and that? What are the tricks behind their sleeve? That's what people are not talking, because people don't read anymore. I think it's a 25-page report. People stay at the first page.
And that kind of went viral, and everyone's kind of sharing and talking about that chart. We should have that chart on this
absolutely
on this page.
The Fund Returners Index is another report that caught a lot of attention, in part just because it was very well articulated in terms of trends happening in venture. It also highlighted Kauffman Fellows have, a 1 in 5 chance of investing in a unicorn business. That's really looking at the last 10 years. And I'm curious how you think about what the report in 2036 is going to look like. And to add a little bit more to that question, what are the big bets you're making today? You're very focused on educating, providing those cheat codes or what have you for investors, or taking a couple of years off, so to speak, of time so that they get there faster. What do you think is going to influence the outcome of what that report says in 2036?
So last year we decided to create this fund returners report. And I think it's important to explain what a fund returner is. So in VC, you make an investment, and the power law dynamics of the industry, what that actually means is that if you make 10 investments, let's say, generally what happens is 1 out of the 10 companies becomes very successful to the point that the total exit, the proceeds that go back to the venture capital firm, pay the entire fund. And the rest of the investments are not going to do very well. That's just the nature of the power law. So a fund returner is precisely a startup that you invest. You can invest in 30, 50 companies. One of them pays the whole fund and the other 49 will not. And the way you make profits is you hope that you get 2 or 3 fund returners, because that's your 3x return expected for a venture capital firm. So the way that if you were investing in venture capital firms, if you're an LP, what that means is that you want to look at the track record of those investors. And that means you want to look, have they been able to source, pick, and win competitive investment opportunities that then become a fund returner. And that's what the best VCs in the world can do consistently. So we decided to take a look at our own fellows. We have 1,000 graduates in our 30-year history. And if you think of Kauffman Fellows, we're like Harvard Business School, if you want, just focus on ventures. So we have a recruitment process. Each year we have about 1,200 to 1,500 people apply to the program for 50 to 60 seats per year per class. So it's a competitive process. And we've been doing this for 30 years. So we have about 1,000 graduates today. And we looked at the data for the last 15 years. It's not 10, it's 15 years. And that's because PitchBook goes back 15 years. And before that, there's no way to find any information, like it's empty. So we looked at the last 15 years, and there's been about 250,000 startups between PitchBook and Crunchbase that we were able to sort of pull that have raised a pre-seed or a venture capital round. It doesn't count angel rounds, right? It's just like institutional venture capital money, but 250,000. And 1.5% of those have become a unicorn. And then exits or whatnot. So I said, how have the Kauffman Fellows fared? Because that means that it's 1.5 out of 100 companies that become a unicorn. So I said, it's not the same a fund returner than a unicorn, but I assume that if you invested in a startup that becomes a unicorn, chances are that's going to become a fund returner. So it's a proxy unicorn for fund returner. There's a reason why unicorns became this thing in venture, the $1 billion valuation, and it's because it's the math that you needed to return a fund. So it turns out that in 20% of every minted unicorn in the world in the last 15 years has a Kauffman Fellow on the cap table. And then the other way to look at it, because it could be a Kauffman Fellow that has more than one unicorn. 1 in 5 Kauffman Fellows has invested in the last 15 years in a startup that became a unicorn afterwards. So it's a good rate. I mean, 1 out of 5. It's better than average if you think in venture.
Yeah, it's significantly better.
We think the average in venture is probably 1 in 10, 1 in 12 VC investors that found a unicorn. So we're twice as good as the average, but that has to do with the selection process by itself. We're not random letting anyone in. So I think it's part of that. Hopefully part of that is also the skills that you learn during the program, although that's much harder to prove. We don't have so much of a control group. I think what's going to happen in the future is that we should see a lot more fellows finding unicorns, only because for the first 20 years of the Kauffman Fellows, maybe 15 years, we were entirely focused in the US. And that meant pretty much focused in the Bay Area. And it's in the last 15 years when we started to go outside to Singapore first, India, LATAM. And today, about 50% of our new cohorts are US-based and 50% are coming from outside of the US. So it just means that the pool, so these 250,000 startups that I'm talking about, that's a US market. PitchBook and Crunchbase is basically US data. So my guess is that our pool becomes much bigger, and we're going to start to see a higher rate of Kauffman Fellows, venture capitalists that find unicorns in the future, just on account of what's happening in the world. Look at India, what happened with Grow. It's an incredible success story, and you're starting to see more of those in multiple parts in the world. So very excited for what's coming in the future.
And I want to shift gears a little bit. You talked about founder, initially founder market fit, then product market fit. And then both for venture capitalists and for founders, it's about the team. Just want to understand from you, you've been a proponent of you created a culture rank. Can you talk a little bit more about building teams and what culture rank is all about?
So I think, I'm not a founder. I've launched things, but I don't consider myself an entrepreneur or founder. But it kind of doesn't matter for this question, in the sense that imagine you're a CEO. You're going to go through 3 stages of your life, and it's the CEO of a 2-person company, just starting, the CEO of a 30-person company, and the CEO of a 300-person company. So you can expand those numbers any way you want. So the first stage, and this goes back to where we were talking about of what is the one thing that we like to see in founders and the obsession. So when you're a team of 2, it's founder market fit is, can we find a solution to this painful problem? There's no management, there's no team, there's no meetings, there's no culture of the company. It's 2 people trying to solve a problem, and the 2 people are in sync all of the time, connected 24 hours a day. They sleep the same problem all the time. There are no cultural problems at the company. There's nothing. There's nothing. There's no company, just 2 people. And the next stage, a small team, 20, 30 people. Product market fit, the obsession to making 10 customers love the product. You're not scaling yet. There's no management with a team of 25 people. There's no company culture. There's no meetings here, meeting there. You don't need Slack. You don't need all of these, task management tools. None of that matters. No metrics, no head of revenue, nothing, none of that. It's just shipping the features that make these 10 customers absolutely love. You're sort of doing the things that don't scale. I like the 0 to 1 approach of Peter Thiel, so that's between founder market and product market fit. And it's the third stage that you got those 2 that now you focus on attracting the team, and the team starts growing from 30 to 50 to 60. There's a point when people in the company start saying, wait, what am I supposed to be doing right here? Right. And I have no clue what that team is doing anymore. And now we actually have teams. Before, there's no team, there's no line. Everybody's doing everything right. So management matters. I hear this thing of VCs or opinion makers online saying that management sucks. Like entrepreneurs should forget. It's not about management. Just focus on shipping product. No, I guess they've never scaled a company before. Ben Horowitz, I actually think he's made his personal brand focused on that management aspect of the work, which is the hustle of growing a company. So back to my, career is, when I was at Endeavor Mexico, my job was pretty much product market fit. When I became president and moved to New York, the team was 30 people in the New York office, and we had 9 offices around the world. I made the mistake of approaching my job as product market fit when the product was already working. So it took me a while. I remember doing these surveys. It was like nobody teaches you these things. But I did this annual performance assessment survey where we asked everyone on the team, how are you doing? How do you feel? And whatnot? And what do you think of your work? What do you think of your manager and everything? And it was not anonymous. You had to type in your name. And I was the best boss in the planet. It was incredible. It was all happiness. It was all perfection because it was attached to the name. But even worse, compensation happened after that survey.
Yeah.
Bonus was so. Until one day, I remember very well. We had a junior person launching the area of people, and he approaches me and says, that may be a little bit biased. And what do you mean biased? Well, yeah, let's do it next year anonymous and see what happens. And it went from a 10 to a 4 to a 5. It was brutal. To me, it was almost a devastating blow of saying, what the hell? It's imposter syndrome, like what I've been doing all this time. But I learned through those punches that my job was not product market fit. My job was scaling, talent market fit. My job had to be focused not on this shipping thing, but 90% of my time focused on the people. So I did nothing in my day other than focused on meeting the teams, the people, building the communication strategy, building the management structure to ensure that everybody knew what was expected of them and could execute. And whenever something got stuck, the communication of how it got stuck doesn't mean that you're not going to get paid your bonus. It means that we need to find a way to unlock that. So I spend my time hiring people, firing people, managing people, 90% of my time. And I learned very sort of trial and error how to become a manager of people. And I proudly can say I'm a good manager. I'm a manager of people, where I don't think most people in tech at least want to spend time managing people. But I think if you ask the best founders in the world, the ones that are scaling fast, they would tell you, if not 90%, because the other Endeavor was growing from 9 to 30 countries. Founders are going from 9 to 1,000.
Yeah.
Maybe they spend 40, 50% of their time on people and 50% on everything else. I didn't have to spend much time on anything else other than people because it was not this massive scaling up. So that's my learning, and that's where my advice to founders: once you have, before product market fit, don't scale, don't do anything, don't focus on management, culture, none of that matters. What matters is customer love just to a few customers. But once you have that, you have to shift your entire mindset to you are a manager. All of a sudden, it's Peter Drucker books that you're reading, not Mark Andreessen books that you're reading. It changes completely the perspective.
There is a gravity that's happening with AI of getting rid of managers. So I think there's the tried and true principles that will probably reemerge. But I think to your point of people in tech building companies, almost try to stay clear of management. They don't think that's core of their customer obsession and building product because that's the origin story. So making that orbital shift, making that next graduation. How do you think, what do you think would be a good approach of thinking about these tools that we have with AI to integrate into management without losing that critical insight and infrastructure that you need to build a real organization?
So I want to be careful that management doesn't mean bureaucratic management. Mm-hmm. So when many people hear the word management and they immediately think of layers and layers and layers. No, intermediation, none of that. Management is the ability to allow people to execute better. That's your job as a manager, nothing else, right? And then there's, the corruption of management that creates incentives for control that then prevent people from doing their best job. But that's the opposite of management. That's just a corruption of management. So I take issue with people that think management is going away, either it's stupid or bureaucratic. No, that's corruption. That's not management. Real management is just that you have one job as the leader of a company, and you make sure that everyone in your company is doing their absolute best. That's it. So how do you do that? And I think that one thing that I like about the book that Ben Horowitz wrote, The Hard Thing About Hard Things, is that sort of this natural continuation to a previous book, which I call the Bible of management for startups, high output management.
Andy Grove.
Andy Grove at Intel created this book that it really is the perfect guide to how do you have a team of highly competent technical engineers building so many different things within the company, some of them related, some not. There's some cross-communication, some not. There's some budgeting process. But this book is a precise Bible, step 1 to step 10, of building an incredibly high output team. And then I think the Hard Thing About Hard Things evolves on that. And the book gets quoted many times, the high output management in Ben Horowitz's book. That's the type of management that I feel startup founders need to start to embed on. Like you need to start to understand that. Because otherwise, if you just think of management hiring intermediation, if you think of management as delegating stuff, you're already in trouble. The idea that you delegate, first of all, people want to delegate the boring stuff that you don't like. But I assume most people don't like to do that stuff as well. So that's not the principle. No? You can delegate the things that you're good at because someone can do them better than you. That's sort of the concept of management. Anyway, I went on a diatribe because I'm a defender of management in that when well done, you can't see a company succeed without it.
It's a management as a essential ingredient to facilitate better execution is so powerful, and just as you navigate the change, it's so I think that's the best definition of management that I have come across, and something that I'm going to take away from the conversation, because it's the people empowering that execution team and ensuring that the right incentives, right org structure, it's not getting in the way, but it's actually facilitating execution. It's so much easier said than done. And
I would say the founder of a company should interview the first 100 people in a company. All of them should have been interviewed by the founder of a company. And that means that you have to interview, 10 candidates per each. So that you're already talking about 1,000 interviews that the founder of a company has to do in the first 3 years of a startup that goes into scalable. So just if you put that into the calendar, 1,000 meetings, plus all the feedback process of that, that's 50% of the time of a founder. And if you're not doing that, what else are you doing? That's how, by the way, you set the right culture is because you're hiring the people that you think will fit the culture that you want to create in your company. Well, that's management. Well, that's part 1 of management. Part 2 is you hire the first 100. How do you make sure they're all doing the right thing at the right time?
Understood. Now, we are living at a moment where the technology, you talked about product, venture capital being acyclical, entrepreneurship in general being thought of as acyclical, but there is the product waves, and we're sitting at what's a big wave, and it feels like the center of gravity for the venture world, entrepreneurship world has shifted back to San Francisco and the Silicon Valley. And with that as a base, how do you see the next, and what does it mean for all these emerging cities that are competing with talent and trying to build companies and startups, and for managers as well as for founders from these cities?
So I think the first, let me break it into 2 parts, like the AI as a business model, and then what does that imply for entrepreneurs worldwide, not just in the Bay Area? And there's a separate question of the re-centralization of the Bay Area as the epicenter of the world, which I not necessarily agree with, but we can touch on that as well. So, you did mention AI doing a lot of the job of managers, or the expectation is that AI can do the job of at least intermediation of managers. I guess I studied enough matrix algebra and probability theory because of my years as an economist. Again, I can't remember any of that stuff, but it was enough for me to understand most of the things in Attention is All You Need, the paper that gave birth to the transformer model. So I believe that as long as AI, as long as the attention is all you need is the heart, the soul, if you want, of AI models, that means that it's a computation of matrices and vectors and a probabilistic model of what is the most likely word that comes after a string or the most likely action that comes after a string of actions in agents. So because it's probabilistic, you can think of any job in the world. The three of us have a job to do, and that job has inputs that we take in to produce outputs. Right? So think of your job as the predictability of the inputs that you get and the predictability of the outputs that you produce. So let's take accounting, book entry. The predictability of inputs, if you give me bank statements, I can create without a trial balance. That's highly predictable. I can create a trial balance, and with that I can create a P&L, a balance sheet, and a cash flow statement. That is the output that is highly predictable. No question in my mind that AI will take over those jobs that are highly predictable inputs, highly predictable outputs, because it's science, it's there, it's 100%. There's no need to predict anything. The instant that you need judgment of probabilistic values in the inputs and in the outputs, AI starts to be a little bit less competitive. It can be helpful, but I don't think it can replace, at least not the attention is all you need probabilistic model of AI. Cannot replace, because at some point, you need a human in the middle making a judgment. That's why I think venture capital, for example, you see a lot of AI models substituting for analysts, writing an investment memo, inputs and outputs. There's no reason why an investment memo cannot be done by AI. Should you invest in this company that wants to allow people to sleep on the couch of your house? There's no data that says you should do that. Actually, the data should tell you don't invest in that. The probability that sucks, and there's a reason why nobody wanted to invest in Airbnb until somebody said, wait a minute, you don't get that out of it. So again, I believe there's a lot of jobs out there where the predictability of inputs and outputs is very low that AI cannot take. And that's good management. I think it's solving problems that are hard to predict. If everything is easy to predict, So that's part one. Part two then means what's the opportunity worldwide outside of the epicenter? And if everything that we read is correct right now, there's the expectation that the cost per token processed is going to go, if not to zero, but it's going to be very low. And that is the only assumption that we have to make there is that energy costs are reduced. If not, it doesn't matter if you're in the Bay Area or you're in Bangalore, it's still going to be expensive. So assuming we fix energy, which is wishful thinking, the cost for token process goes also to zero. So there's absolutely no advantage anywhere in the world because you have access to the same LLMs, you have access to the same labs process, so that the ability to produce with that a product that solves a particular problem. So think of Mexico City or think of any city, any country where you have manufacturing, old-style factories, old-style traditional businesses, that their entire backbone, is built on code that was written 30 years ago. And they put patches all over the place. But for those companies to try to replicate, to try to innovate, it's almost impossible now because if you change a little pathway on this software code here, maybe everything else breaks down. They lost complete track of that. AI can help you with that today. So I'm just putting an example of how every country in the world has its own particular problems that you can put AI to work and become a significant source of profit in the future. So I'm very optimistic in that AI is a democratizator of sorts, that anyone can now build something with AI that solves a very particular problem. What doesn't change is the obsession to solve a problem, founder market fit, the obsession to find customers that love it, and then the ability to execute and grow on that. Then we can talk more about the insular component of Silicon Valley or becoming the central part. I'll be happy to expand on that if you want. But
how do you think of well, first, I love the input-output framework. That's a very clear way of thinking about what AI's role could be, how you can create that leverage in places where people are more creative or nuanced. One of the things that I'm seeing, and I think we're all seeing, are companies of solo founders or two founders getting to pretty significant scale. So the metrics of success to get that seed stage check have gone up tremendously. Funds have adapted. We're seeing a lot of mega funds. We're seeing a lot of very specialized funds. But I'm curious, what do you see as kind of guiding principles or any frameworks you might have in thinking about how to unlock these ecosystems that are no longer constrained to one place in the world, and to unlock that with capital where you can get earlier indications with less capital up front, but then these enormous valuations that make the power law economics a little stranger in some context.
Yeah, that could be a trend or not. Like those are part of the cycle that may go away or may stay forever. And I don't think there's anyone that can say that. But what I think is, it's true that today you could launch a company, whether focused on consumer or enterprise, that through the right application of AI solves a particular problem for someone faster than you could do it before. I do think that's true, and we're seeing it, which means that there's one more thing, which I feel particularly in enterprise. There's so much fear in big enterprise of missing out that they're very willing to be venturesome. They're very willing to take risks in buying from vendors that probably in the past they had no need to do that. And I think that's also, there's something about the American buyer, the American enterprise, that they've always been venturesome. They've always been willing to take a risk in buying from new vendors to try things out. But the rest of the world was not necessarily into that. I think AI provides enough fear in enterprises across the world that are like, buy stuff. Let's just try. We can't stay out of it. So I think that's helping also these founders reach interesting metrics, go from $0 to $1 million to $5 million ARR. By the way, ARR is a whole other conversation to have. But going from $100,000 of revenue last month to $500,000 of revenue this month, technically a $5 million ARR, a lot faster without raising a lot of money. I think that's absolutely true. I think it's also true that the moment that happens, there are enough tracking systems in the planet, the PitchBooks of the world, and much more advanced tools that now venture capital firms can scout with their own AI tools, that if you're an entrepreneur in the middle of Kenya and you went from $0 to $5 million in traction in the last 6 months, you're going to pop up on someone's screen and every VC in the world will be knocking on your door. So, but that also became table stakes for VC firms today. Like if you don't have access to those windows that pop up at success, what are you even doing? So I do believe that it's becoming easier. There's another part of your question of round compression, which is, do I have to raise now, $2 million for the seed, and then $10 million for the Series A, and then $25 million for the Series B? Or can I raise $100 million right now and just keep all of those rounds? And I believe that there are venture capital firms that are saying, yeah, sure, we can do that for you. Mm-hmm. It's sort of if the competitive edge of a venture capital firm is source, then pick, and then win, and you have to win every round. Let's win all the next 4 rounds all together and just do it by now. And there's sufficiently amounts of capital justifying that. Is round compression going to stick? I have no way of telling you that. I don't think that we're going to have to wait 5 to 10 years to know. The exits that happen from this round compression market, we're going to learn in 5 years if it worked or not. I can't imagine that it's going to stick for much longer. I don't think the math works for round compression in the way that we're seeing right now.
I think what's really fascinating, I mean, a couple of insights there, but you have FOMO that's happening on the buyer side. Sales cycles are not really, certainly not predictable, and you wouldn't guess that that's going to be long-term. So you have people adopting products, probably multiple, they're not even going through the competitive bidding process. They are in discovery mode themselves, which is creating a weird signal for the rest of the market. The other was the round compression. I hadn't thought of it that way. Seeing these tremendous rounds, these valuations, I've done a lot of work with ecosystems like StartX, advising founders for their first round. They were at a white paper raising on $1 billion valuation. And so it only, it didn't end up raising because they're debating over the board seat control. So it is a wild time in that sense. I think thinking in terms of first principles, frameworks, having a compass to navigate these times so that a lot of this is the compounding decisions. So how do you build an institution, whether you're building that as a founder, whether you're building that as a venture investor. And so I think understanding how to navigate, let's say, the next 12, 24 months or principles, what do you think it should be top of mind for founders, for investors? And do you think that changes whether they're here in the US, in parts of India, or other parts of the world?
Again, I'll split the answer into answer the last part, where it matters if it's in the US or India or not. It doesn't matter. If anything, my controversial take on geopolitics today, everyone, is the America first, which some venture capital firms in the US are actually proposing, like it's America first and invest in American startups and sort of less focus on global investments. It's kind of good news for the rest of the world, because if you don't have to compete with Lightspeed and Thrive and these funds raising $15 billion, $20 billion, because they're just going to stay in America. Actually, that's good news for the rest of the venture capital industry, because then you'll see a lot less of these crazy round compressions and valuations that we're seeing. I think I joke that the rest of the world will eventually may give Trump the Nobel Prize in economics, because if you think of the European tech scene, how it has exploded in the last 3 years. It's incredible, just because of this America first, America insular, Europe you suck, we don't want all of that stuff, where Europe woke up one day and said, we're going to need to create our own tech. We can't rely all the time on this. So it jump-started an incredible ecosystem. So I think that it really doesn't matter where you are in the world. And Europe, I think, is a great evidence that it doesn't matter that OpenAI and Anthropic are in the Bay Area and centralized. They don't care about that stuff. You see companies like Lovable being an incredibly success story. So I think tech is democratized enough that you can be successful anywhere in the world. And the fact that America becoming a little bit more insular and Silicon Valley or the bigger firms being so focused on not losing in Silicon Valley means that competition of mega rounds is not necessarily happening in the rest of the world. Like there's valuation inflation, but that's always been the case. But not $1 billion out of a white paper with a PowerPoint presentation. Right. That's pretty much Bay Area. Mm-hmm. Maybe you see one of those in New York, maybe one of those in London, but that's it. You don't see that anywhere else in the world. So, no, I don't think that's going to stay, those round compressions. I think it's just a phenomenon of the fund sizes that some firms have raised in the Bay Area, combined with nationalization of America first, where you have all of this money not to invest in the planet, but just in this corner of the world. I think it really comes down to a result like that.
The consistent framework. You're not a contrarian so much. You're seeing the silver lining of a lot of things, these actions where a lot of the attention's going. And then you're seeing, okay, well, this has actually been a catalyst for the European market. This has been a catalyst for entrepreneurs in other parts of the world. Capital going into places and routes where you're actually going to return capital back to through the fund. So I really appreciate that as a through line for our conversation today.
Yeah. And one final question on how you see the arc in terms of 10 years now. Any specific views on what succeeded in other parts of the world? Singapore Endeavor has a Jakarta office now. All of these cities are competing against each other. So Hyderabad has its own success team. Bangalore has its own success, and it's in a good way. Chennai and Delhi and Bangalore and Singapore and Jakarta. So, do you have a view on? Do you have a point of view on what's an exciting place from a 10-year horizon perspective? The next 10 years.
So, India is, of course. If we go back to the first questions of these entrepreneur mafias, the PayPal mafias of the world.
Yeah, you used the phrase bubble before. I hesitate to use mafia sometimes. I prefer biosphere, creating more ecosystem, more life. Mafia is like kind of a, but yeah. Anyway,
think of the word mafia in this context as this. There's a godfather, godmother at the top, and if you're under their wing, I'll protect you, which means I'll mentor you, I'll invest in you, unless you offend me, in which case you're out of my system, right? So, what I think happens, and why I think India has been so incredibly successful, is that you had your Flipkart. It scaled. Founders, investors, local employees learned a lot and made money with that, with a sufficiently high quality of life to stay local instead of taking that money and moving to London. So that's the battle was won there. And then starting their next thing at a similar time when India at the country level was prioritizing public markets, the stock market, and the ability of the Indian population to invest their savings in the stock market. I think with the SIPs, the systematized investment protocol or automated investments, along with DMAT, I think India went from, in the last 10 years, from 20% of the domestic market investing in the stock market to like 80% of the market. And they're not buying and selling shares. They're all doing it to mutual funds, and those mutual funds are like the vanguards in the U.S., the BlackRocks of the U.S. That whenever there's an IPO in India, these large buyers can buy at the initial public offering and then distribute it across the mutual funds, which is an incredible thing to see, that no one else has been able to replicate. No one else has been able. And without that, there's like LATAM, nobody can, unless they fix that problem. Because the whole cycle is, you can have a lot of employees with a lot of stock option at a $10 billion private valuation, but if it's on paper, they can't do anything with that.
Yeah.
It has to become liquid at some point. So liquidity is the flow, the magic flow of entrepreneurial ecosystems. Without it, you can't do it. You don't see it, right? So India problem solved. They tackled that, and that's what gave India the advantage that I think today is safe to say that it's the second most exciting entrepreneurial ecosystem after the US. No question about it.
Fernando, for founders, venture capitalists, aspiring founders, aspiring venture capitalists, and policymakers trying to make their cities attractive, there's a lot of nuggets in this conversation. All they need is to pay attention to this episode. Thank you so much.
I appreciate that. Thanks
Fernando,
so much.
really thanks for today.
Thank you.
Thanks so much. I appreciate it.
Thank you.